Hare Krishna. Welcome to Tax Guru YouTube channel. This is CA Rohanar Pingle, practicing chartered accountant based in Mumbai. Also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to video series GST Relearn. And today is part 13 and we are going to discuss topic returns under GST. So let's dive into it. Let me allow to share my screen. Yes, returns under GST. What we are going to learn. So we are going to learn meaning of GST returns, types of GST returns, due dates of GST returns, late fees and interest on delay, annual return under GST, rectification of errors in GST returns, practical examples of filing returns, importance of GST returns, key challenges and common mistakes, and at the end, we will deal with conclusion that can be drawn from today's learning. So let's start. Meaning of GST returns. A GST return is a statement filed by every registered taxpayer. Who files this statement is every registered taxpayer will file this statement, that is the return, containing details of what? Sales, purchases, output tax payable, and input tax credit claim. These are the contents of the returns. What are it? Sales, purchases, output tax payable, and input tax credit claim. Filing GST returns ensures what? Proper compliance and reconciliation of taxes between supplier, recipient, and government. Who are the parties involved? Supplier, recipient, and government. Let's see example. If a trader sells goods worth rupees 10 lakhs in a month with GST at the rate of 18%, GST will be 1 lakh 80,000, and he purchased raw materials worth rupees 5 lakhs with GST 18%, it will come 90,000. Then while filing the return, output GST liability is rupees 1 lakh 80,000. Input GST we can claim rupees 90,000. So net GST payable will be 19,000. So this will also go into the returns. Let's move on to the second types of GST returns. What are the types of GST returns? It is based on the registered dealer's type. Okay. So let's start. Different GST returns apply to different taxpayers depending on their category, as I said. So GST R1 for outward supplies, that is a sales return. GSTR 3B is a monthly summary return with tax payment. GSTR 4 for composition schemes dealers, for whom composition scheme dealers required to file GSTR 4, not GSTR 1. GSTR 5 and 5A for non-resident taxpayers. GSTR 6 for input service distributors, that is ISD. GSTR 7 for TDS under GST. GSTR 8 for e-commerce operators. And GSTR 9 is an annual return required to file based on your yearly previous turnover. And GSTR 9C also GST audit and reconciliation statement if turnover is more than 5 crore. GSTR 10 final return on cancellation. Okay, GSTR 10 is about final return on cancellation. GSTR 11 for persons with UIN, that is embassies and UN bodies. Okay, they required to file GSTR 11. So these are the types of GST returns based on the taxpayers depending on their category. So R1 for outward supplies, that is sales. 3B, monthly summary return with tax payment. GSTR 4 for composition scheme dealers. For non-resident taxpayers, GSTR 55A. For ISD, input service distributor, GSTR 6. For TDS under GST filers, GSTR 7. For e-commerce operators, GSTR 8. And GSTR 9 is annual return based on the turnover it is applicable. GSTR 9C is also GST audit and reconciliation statement if turnover more than rupees 5 crore. GSTR 10 is a final return on cancellation. And GSTR 11 for persons with UIN, embassies, and UN bodies. Let's see some of the examples. A manufacturer filing monthly GSTR1 sales and GSTR 3B tax payment. A Kirana store under composition scheme, which returns he will require to file? Only GSTR 4 annually. Only GSTR 4 annually. So after types of returns, we will moving to due dates of GST returns. There are various due dates to file those returns. For GSTR1, 11th of the next month if you are following monthly periodicity, and 13th of the next quarter if you are under quarterly scheme. Okay. GSTR 3B 20th of the next month, and various other rates are also based on the quarterly. Means quarterly also required to file means next quarter by 25th of the date based on the state level of dates. Okay, GSTR 4, 30th April following the financial year. It is an annual return for composition dealer, and the due date is 30th April of the following financial year. Okay, and 99C, 31st December following the financial year. Means if year ends at 31st March 2025, then the due date will be 31st December 2025. Example, for sales made in April 2025, GSTR 1 should be filed by 11th May 2025 and 3B by 20th May 2025 if we are following monthly periodicity. Okay. Next, late fees and interest on delay. Late fees will be rupees 50 per day, that is 25 rupees CGST and 25 rupees SGST for normal returns, and for nil returns rupees 20 per day, 10 for CGST and 10 SGST, and interest will be leviable at the rate of 18% per annum on unpaid tax. Okay, for example, if tax of rupees 50,000 is paid 20 days late, interest will be calculated 50,000 into 18% for 20 divided by 365 days, rupees 493 approx. This is a calculation example of interest on late payment of tax. Let's move on. Annual return under GST. All regular taxpayers must file GSTR 9 annually. Taxpayer with turnover above rupees 5 crore also require GSTR 9C certified by chartered accountant or cost management accountant. GSTR 9 actually up to 2 crore turnover, there is no mandatory requirement to file the GSTR 9. Whenever your turnover exceeds rupees 2 crores annually, then you are required to file GSTR 9, and up to if your turnover is between 2 crore and 5 crore, then only 9 is required. But once your turnover crosses 5, then you have to file both 9 and 9C, that is a reconciliation statement. Okay. Currently, there is not required to, there is a GSTR 9C is a self-certification by the customer only, that is registered dealer only. Example, a traded with turnover rupees 3 crore files GSTR 9, and a company with turnover of rupees 8 crore files what? Both GSTR 9 and 9C. Next, rectification of errors in GST returns. Errors can be rectified in what? Subsequent returns. Rectified in subsequent returns, but only up to what date? 30th November of the next financial year. Earlier limit was September, but now 30th November of next financial year. After that, you cannot able to rectify the GST returns Okay, so if you want to rectify GST returns for the financial year 24-25, then date would be 30th November of 2025. By that date, you can rectify whatever errors you are find, then you can rectify it. Credit note, debit note, or amendment facility is available. Example, if sales invoice of rupees 1 lakh was wrongly shown as rupees 10,000 in May 25 GSTR 1, correction can be done in subsequent GSTR 1 before 30th November of 2026. Let's move on to practical examples of filing returns. Let's see example 1, regular dealer with IMS acceptance required. Scenario, April 2026, sales 20 lakhs plus GST 18%, output tax liability rupees 3 lakh 60,000, purchases 15 lakhs, GST 18%, input tax credit rupees 2 lakh 70,000. So amendment, that is up to old system up to 30th September 2025, purchases uploaded by the supplier in R1 auto appeared in buyer GSTR 2B. Buyer simply claimed rupees 2,70,000 ITC in GSTR 3B. But now with effect from 1st October 2025, please note down it. This is the amendment from 1st October 2025. Purchases uploaded by supplier in GSTR 1 appear in what? Invoice management system, that is IMS. Buyer must accept that invoices of rupees 2,70,000 in IMS. If you not, then it will be lapsed. It will not be auto populated now as per the old system. Only after acceptance, these invoices appear as what? Eligible ITC in GSTR 2B. Buyer claims ITC in GSTR 3B. If buyer forgets to accept, ITC will not flow to GSTR 3B. Buyer must pay full rupees 3,60,000 in cash. Therefore, please get it noted down. You need to accept it, whatever credits you are getting on the portal. So net liability after proper action, output liability 3,60,000, ITC accepted in IMS invoice management system rupees 2,70,000. Net GST payable in 3B would be 90,000 if you accepted it. If you forget to accept it, then credit will not be auto populated as populated in earlier old system. Let's see example 2. Composition dealer. No ITC allowed. IMS not applicable. Composition dealer ITC cannot claim at all. So IMS not applicable. So turnover of financial year 25-26 50 lakhs. GST payable under composition scheme at the rate of 1% is 50,000. Filed via CMP 08 quarterly. At year end, GSTR 4 annual return will be filed. So IMS doesn't affect composition dealers since ITC is not available to them. So this effective amendment from 1st October 2025 have no effect for composition dealers. Example 3. Mistakes in IMS. Invoice not accepted on time. Cases. Let's see. Buyer X Limited purchases raw material worth rupees 10 lakhs plus GST 1,80,000 from supplier Y Private Limited in November 2025. Supplier uploads its GSTR 1 on time. Invoice appears in buyer's IMS, but what buyer forget to accept invoice before the filing November 2025 3B. So impact will be that 1,80,000 ITC is not reflected in GSTR 3B. So buyer pays full tax liability in cash without credit benefit. ITC can be accepted in subsequent months once action taken in IMS, but cash flow is blocked. Means that particular month your cash flow will be blocked, so you can able to take a credit, but your that particular month you have to pay full liability. So you can take ITC later. It is possible, okay, in subsequent months. Example 4, wrong invoice accepted. Buyer mistakenly accepted an invoice not belonging to them, is uploaded by someone dealer on this GSTN number, and buyers mistakenly accepts that invoice not belonging to them, that is wrong GSTN entered by the supplier. ITC wrongly reflected in 2B and claimed in 3B. Okay, once you accept it, 2B will auto-populated that. credit and you are claimed in 3B. Later, during department audit, this ITC is disallowed with what? Interest at the rate of 18% and penalty. This shows why careful validation before accepting invoices in IMS is essential. So you have to be very careful. You have to train your staff, your article systems while dealing with this. Now the new system is applicable. So you are very careful while accepting the ITC populated by through GSTR1 by the supplier. So that is also care need to be taken. So what are the key learning from the practical examples post 1st October 2025 is ITC will not flow automatically. Taxpayer must take action in IMS, that is invoice management system. Wrong acceptance leads to what? Ineligible ITC claimed and penalties at the latter time. Cash flow impact if invoices are missed or kept pending. This is a major thing. Your businessman's working capital will get blocked if you have not able to or forget to accept the invoices of ITC. So composition dealers remain unaffected. They have nothing to worry about it because ITC is not claimed by composition dealers. Next part, importance of GST returns. What is the importance of GST returns? If you see, it ensures compliance with GST law, helps in claiming what? Your input tax credit, avoids penalties and interest, builds what? Trust and avoids departmental scrutiny. Means timely filing GST returns with a complete clarity, complete with where complete care you can build trust and avoids departmental scrutiny too. So what are the key challenges and common mistakes? So missing due dates leading to what? Late fees, wrong GST and entry by suppliers affecting what? Buyer's credit, and non-reconciliation with books of accounts will also lead will later at the time of scrutiny you will be get penalties and all the procedural impacts from the department. So these are the needs to be taken care of. Automated ITC flow is discontinued from 1st October 2025. That is, buyer must now accept, reject, or pending invoices in the invoice management system. Example, with respect to IMS, no auto ITC from 1st October 2025. Old situation before 1st October 2025 is what? The buyer used to rely on to be is auto-populated input tax credit and simply claim them in GSTR 3B. If the supplier didn't upload a corresponding invoice in R1, the buyer could lose that credit because it wouldn't appear in 2B, a mismatch issue. New situation from 1st October 2025. Automatic population of ITC into 3B from 2B is discontinued. The taxpayer, that is recipient, must manually act, that is accept, reject, or pay via IMS on GST portal so that the eligible invoices are included in 2B and thereby in GSTR 3B. So let's see illustrative example under new rules. Suppose a buyer X Limited receives a B2B invoice from Y suppliers in October 2025 for rupees 2 lakhs plus GST 36,000. This invoice appears in X Limited's inward supplies section of IMS as no action or pending. If X Limited fails to accept or take any action this invoice in IMS before filing GSTR 3B, the invoice will not included in 2B's eligible ITC section and thus will not auto-populate into 3B's input tax credit tables. As a result, X Limited what loses the opportunity to claim that 36,000 ITC in that tax periods GSTR 3B unless they take corrective action in next periods if permitted. If X Limited doesn't accept within time via IMS, then the invoice will reflect in 2B eligible and can be claimed in 3B. If X Limited rejects it, then that invoice ITC will be excluded permanently from eligibility unless supplier issue correct invoice. If X Limited marks it pending for later review, it will not include it until accepted. Means these are the three options are given. Either you accept it, either you reject it. Once you confirm that the ITC is not for you, means you are it is not a correct ITC, and if you are not sure to take the action, then you can put it as a pending for review. And still that it is on the portal, means once you confirm it is your ITC only, then you can after pending review you can accept it for your ITC. But and if you confirm that it is not your ITC, then you can outright then from pending review to reject it. So these are the three options now available. Thus, under the new regime, the burden is on what? Recipient. Burden is on the recipient to ensure invoices are accepted in time via IMS, or as even though the invoice was issued and supplied, the corresponding ITC might be lost for that period. So, what would be the takeaway or pitfall? We can say many taxpayers may mistakenly assume that ITC will flow automatically as earlier, but from 1st October 2025, failure to act in IMS leads to non-reflection of ITC in GST R3B, even if the supplier has uploaded the invoice in R1. So, you need to have take a action, train your employees and staff to check this IMS system, accept and reject transaction. Okay. So now we are moving to conclusions that can be drawn from today's learning. Okay. Let's see. Filing GST returns is not just a compliance formality, but a critical process that directly impacts what? Working capital, ITC eligibility, and tax liability. From 1st October 2025, the mechanism of automatic input tax credit flowing in 3B is discontinued. Taxpayer must now actively manage ITC through the invoice management system by making supplier invoices as accept, reject, or pending. This shift makes GST compliance more what? Interactive and responsibility driven for recipients, ensuring what? Only verified invoices are used for ITC claims. Okay. So risks under the new regime is failure to accept invoices, ITC loss in that particular period, leading to higher cash outflow that particular period. Wrong acceptance will be ineligible ITC claimed and attracting interest and penalty at a later stage. Delay in action, cash flow blockage again, and reconciliation mismatches. Practical takeaway is that business must strengthen internal GST compliance process, train teams to use IMS effectively, and reconcile invoices regularly to avoid cash crunches and litigation. Composition taxpayers remain unaffected, but all regular taxpayers must adopt this new workflow for ITC management. In short, GST returns compliance has become more dynamic post October 2025, demanding timely action and vigilance from taxpayer for smooth credit flow and reduced tax risks. So, this is all for today. Hope you are learning and getting benefit from this video series. Stay tuned to Tax Guru YouTube channel. If you are not yet subscribed, then do subscribe it. If you are like this video, please click on like and share in your network. It is necessary to share the knowledge with our fellow members, fellow staff, fellow students. These are very necessary. So stay tuned. Bye bye. Take care. See you soon in next video. Hare Krishna.